Okay, so as we still continue to move on in portfolio performance evaluation, one of the areas that keeps coming up and will probably continue to keep coming up is this idea of benchmarks. What is the accurate benchmark? What really represents what we're trying to do? It sounds a lot easier than it really is. There are some assets that are just very, very difficult to benchmark. So I really like this section because it's going to give you some advice in dealing with some of those difficult topics and difficult benchmarks. And I think this is all very reasonable information that could be heavily tested. And as we deal into with liability-based benchmarks, remember, when we're dealing with institutions, especially defined benefit plans, banks, and insurance companies, this liability-based benchmark or this asset liability management method is the one that's recommended and likely used as well. So again, a more frequent benchmark in institutional investing is going to be the liability-based benchmark. And this is likely used by fund sponsors and portfolio managers when they have a known specific liability to pay in the future. So this liability benchmark, it's going to focus on having the cash flows necessary to satisfy that liability. And I can tell you from experience, it actually is going to make a lot of your investment choices more difficult, because it's going to limit often the investment choices that you have available to you in order to build this portfolio. Okay, so what are some frequently used assets with liability-based benchmarks? Well, nominal bonds, absolutely. Inflation-adjusted bonds, don't think they get enough love. A lot of people don't use them, but absolutely, I think they're a great option. And then high-quality stocks. Okay, so when you're also getting into this idea of benchmarking and management, so what's going to happen, some of the plan features that you're dealing with a defined benefit plan are going to actually impact the types of assets that you should be choosing basically to meet these cash flows. So what are some plan features that are likely going to impact this liability and how you need to plan to have the available cash? So how about how many years until the average number of workers are going to retire in the plan? You know, remember what we're focusing on here, again, is ability to bear risk, and that's time horizon and liquidity. So if I have a long time until the workers are going to retire, then I have a long time horizon. I have a long ability to bear risk. It's just I have above average ability to bear risk. Now, how many workers have already retired and are drawing cash from the plan? So this idea of retired lives, very important. And don't forget about inflation, especially today. It seems like inflation's been dead topic for, gosh, I don't know, maybe a decade or so, but we are starting to hear more and more people talk about inflation. Now, the other thing that I want to focus on is what about the correlation between the company's operating profit and the plan assets? If they're heavily correlated, when the company really needs money because the plan assets have really declined, they don't have it available. So I'm really looking at the correlation closely. Another thing I want to take a look at, is it a frozen plan? Does it have a terminal life? This lowers the time horizon. And again, it lowers that ability to bear risk. Okay, and any actuarial assumptions, so life expectancy, discount rate, all of those things, again, are going to impact this ability to bear risk, which is going to have an impact on which securities that I can build that portfolio with. Okay, so let's look at some benchmark types. There's 7 primary types of benchmarks that are covered in the CFA3 material. So we have an absolute return. So earn a fixed number. Okay, earn 5% every year. We could have a manager universe. I don't know who these managers are, but I want to earn the median manager return. A broad market index. Hey, I tell you what, outperform the S&P 500. A style index, absolutely can use as a benchmark. Factor model based. This has become more prevalent, and oftentimes they're more complicated than just a single factor model like the CAPM. We can use return based. So earn the return that would have been received from, let's say, weighting a particular style. And then where we see a lot of benchmarks, we see custom benchmarks. So there's going to be some combination. Okay, so I think these are good to know. We've seen them in level 1. You saw them in level 2. Now they're back in level 3. I would certainly be familiar with this list. The material we have put together here at Kaplan, I think, is extremely helpful. Okay, so now we've got a little chart that can help you understand, again, it's not enough just know definitions. I want you to know advantages, and I want you to know disadvantages. Now, do you need to know every one of these? No, but I would like you to pick out a couple that favorite. So a few that I would recommend, I want you to think about an absolute benchmark. Simple, earn 5% a year. Disadvantage, it's not investable. Okay, what if well, give me the manager universes. Well, I can quantify if I can get my hands on all the different returns, I can measure that. But remember, it's subject to survivor bias because these managers that didn't make it, they're not reporting. It's generally optional to report that number. Now, I want to bring your attention to the broad market index. So these are widely available. They're investable, measurable, specified in advance. They're perfect, except for one thing. What if your style of your portfolio manager is different than the index style? Unfortunately, many clients continue to reference this broad market index where the reality their portfolio might look very different. So this is absolutely a point of contention with clients, and you've got to make sure that they're understandable about this. Okay, let's look at another one that seems to get a lot of attention, factor model based. So I like these. What's the advantage? I built this. It can actually help me understand the style. Now the problem is it's not intuitive. It's not easy to obtain. It can be specified in advance. Unfortunately, at the end of the day, there are a lot of weaknesses. There's really a lot of problems with using factor-based models as benchmarks. Okay, returns-based, easy to use, no problems, but we have some style issues if they don't match. And then finally, a custom security-based, so it meets all the benchmark requirements. So why doesn't everyone do it? It's expensive and it lacks transparency because it's custom, and I'm going to keep it proprietary. Okay, so let's go into some custom security-based benchmarks. And again, this is very popular, definitely gaining popularity. So we're going to identify the manager's investment process, their asset allocation, including cash and weightings. We're going to do some regression of past returns, and we're going to use the same assets and weighting for the benchmark, and we're going to assess and rebalance that benchmark on some predetermined schedule. Okay, so nothing too surprising there. Properties of a valid benchmark. You saw this in level 1, you see it in level 2, and it's back in level 3. Remember our friend Samurai. Okay, this might be 1 or 2 questions on 1 or 2 points on the exam. Absolutely go back and look at this. I think the slide that we have here at Kaplan is about as deep as I would go into that. And then we can actually look at benchmark quality evaluation. So remember, we can break down a portfolio into its three components. So the market style and active management. So let's go ahead and take a look at what we have here. So we can take a manager's portfolio return. It's going to be that market return plus any incremental return that they get from the style plus any alpha. Okay, we can also, in contrast, take a look at the investment style, and we can calculate that from the manager style benchmark, from the overall market return. And then again, what are we doing? We're generally hunting for alpha. So what is alpha? That's going to be the manager's portfolio return minus the manager style benchmark. So again, just a few things that we can do. We saw this again in all three levels of the exam. It does come up from time to time. It's actually pretty handy. We have a sheet here that kind of summarizes what I just said. So a passive investing in the market portfolio is going to earn M. Passive investing in the style benchmark is going to earn B. And again, an active manager seeks to earn alpha. That's the goal. We're still hunting for alpha. Okay, and this does ignore any transaction and management expenses, but it's a good ballpark, and it comes up from time to time in questions. So let's talk about some of the difficulties with benchmarking alternative investments. And especially when we're dealing with institutions and we've seen a huge number of increased percentage of portfolios in alts, understanding some of the difficulties is absolutely important and highly testable too. So there are three general types of benchmarks that seem to be considered for hedge funds. We have broad market indices. We have a risk-free rate. I see this all the time. And we see a hedge fund peer universe. Now, unfortunately, all three of these benchmarks have some problems. And I would like to know these for the exam. So broad market indices are generally not appropriate as benchmarks. Why? Because hedge funds cover a wide range of investment strategies. The hedge fund likely differs significantly from other hedge funds also. Also, we factor in leverage, short positions, and derivatives. Again, these broad market indices just are not representative of this. And then at the end of the day, don't forget there's a lack of liquidity, transparency, and it's even difficult to monitor these investments. So broad market indices are really not appropriate as a benchmark for hedge funds. And then finally, there's a low or no correlation of returns with the broad market index. So it doesn't make sense to try to compare that to these broad market indices. Now, the other strategy, again, that I see a lot is let's go ahead and just use the risk-free rate with some added spread. So the majority of hedge funds are going to carry some systematic risk. This actually exacerbates the risk, meaning that spread actually has to be increased. And unfortunately, this lack of correlation of the hedge fund returns and the risk-free rate, it makes this risk-free rate an unsuitable benchmark, even though it's very often seen in the industry. Okay, what about peer universes? This comes up pretty frequently too. It's not suitable because specific peer groups' risk and return objectives might not match yours, and they might not match your fund. Also, we have backfill and survivorship bias issues, and current pricing is very difficult. Oftentimes, we're using some form of appraisals or prior period price, and there may even be a smoothing effect. And what does a smoothing effect do? Well, if we're looking at a Sharpe ratio, it lowers that volatility of the denominator. It makes the investment look better from a Sharpe perspective than it really is, and then you want to put even more of the percentage of the portfolio into hedge funds. So again, all three of those are really not good methods to benchmark hedge funds. Okay, what about real estate? That brings a new set of problems. So benchmarks are derived from a sample of a real estate universe. So they're not completely representative of the actual real estate class. There's also very likely a high correlation to the largest investments. And then just like with hedge funds, their returns are self-reported and they could be biased, maybe to more expensive geographical areas. Okay, what are some more issues? Well, we've got lack of use of appraisal data. So it's going to lead to the smoothing effect, and again, it's going to underestimate the volatility or the true risk that we're dealing with. There's also lack of comparability with benchmarks, that maybe some of these are using leverage, some not, and then they assume no transaction cost, full transparency, and normal liquidity. When we're dealing with real estate, that certainly doesn't sound very likely to me. Okay, what about private equity? Well, there are benchmarks that exist that allow for performance comparisons, and that comparison versus a relevant peer group. Also, there is a common metric that we use, which is internal rate of return. Okay, there's some problems, though, with this benchmark. So maybe a manager's using some different method of valuation, so you're not making an apples-to-apples comparison. And then using internal rate of return, it's going to be biased in the beginning by any substantial losses or gains. So maybe internal rate of return might not be an appropriate measure. Okay, what about commodities? So benchmarks for commodity investments, they're usually based on futures, not the actual assets. So similar to other alternative investments, there's different amounts of leverage, there's different weightings, and these weightings and the fact that you're using futures instead of the actual assets, these become very problematic when you're trying to use these as benchmarks. What about managed derivatives? So they use specific benchmarks because there's a lack of market indices. So these benchmarks may be too specific or not specific enough, and therefore not at all suitable. And there are peer groups, but just like any peer group, it's self-reporting. They don't report all the time, so there's stale repricing, there's survivorship, and there's even backfill biases also. So again, there's some problems in managed derivatives. What about distressed securities? Hey, more problems. Given the illiquidity and severe lack of marketability of distressed securities, it's almost impossible to determine appropriate benchmark. So think about that. They're saying, hey, and let me help you manage your money, and then there's no way to figure out if they did a good job or a bad job. From a fund manager perspective, that sounds really good for the fund manager, but it doesn't sound so much good for you if you're in charge of the due diligence of this. Okay, and at the end of the day, any model that we talk about in this program, we have garbage in, garbage out. We have misspecification problems. Any of these issues basically make any analysis misleading and quite honestly worthless. So if we're going to also do any type of evaluation, we're going to require an appropriate fund benchmark. Okay, so when an incorrect benchmark is used, then performance measurement, attribution, appraisal analysis, pretty much everything that we've been talking about, unfortunately, becomes very worthless and actually can provide you misleading information. So again, I know we talked a lot about benchmarks. We could talk for days about benchmarks. There's so many issues. It's also a very interesting area to be involved in from a career perspective as well. There are many firms out there and people that earn a good living designing these benchmarks. Why? Because it's complicated. And for the exam, I think it's really important to understand some of the weaknesses of these benchmarks that are mentioned and that are being used in the practitioner world. Not only will it help you score points on the exam, but it'll also help you in the real world.